it would take quite a unique person to come up with pinball wizard as a definition for a good Fed chairperson. What do you think?
I think it's the appropriate pick for the current circumstances. Tommy the Pinball Wizard, #1, wouldn't be overly sensitive to markets, commentators, and politicians. #2, he wouldn't give meandering speeches that contradict themselves over time. And #3, control of a pinball is probably as good a way as forecasting the global economy as the macro models Fed officials currently use.
Yeah, and you know, the problem is that there's no tilt. I wish we could tilt this game and kind of put another quarter in and start over. You know, we discussed off camera, I personally don't believe the Fed really has a huge influence on the Fed directly, but I do think he has an influence on the markets, as we discussed. Why don't you tell me your version of this interaction that's going on that's inserting so much volatility into FX and global interest rates?
Yeah, Fed officials go out of their way not to be influenced by politics. They're sensitive to criticism, obviously, but what they really are sensitive to is markets and market pricing. If the president and his tweets can influence market pricing, therefore it's going to influence what the Fed does. So the issue isn't the Fed listening to the president, it's the Fed listening to financial markets that spend an inordinate amount of time listening to the president.
You know, Vincent, let's all be honest here. We don't know when. It could be 1 month, it could be 1 year, it could be 8 years before we get to the next recession. But the issue is we're going through global slowing and central banks are trigger happy, and it seems like our Fed had a large role in making them trigger happy to get in front of the world's most powerful Fed. And that dynamic just is sending really bad feedback loops into equities. Do you agree with that feedback loop?
Well, I don't agree with current pricing, but I think it's got two parts. We are pretty close to a manufacturing recession. The trade uncertainty has been tough for global trade. It came to a grinding standstill. No change over the last 12 months in the first part of this year. That's affected manufacturing. We're through a bit of an inventory cycle. But you know what? Trade's not that important to the U.S. We're a service economy, and services are still plowing ever upward. So I think the recession risks are overstated. The second part of it is most economies of the world, policymakers have a fear of floating. They don't like to see their exchange rate appreciate. Because basically an exchange rate appreciation is you giving some of your growth to your trading partners, and no one likes to do that. What happened is now is the currency to which they all are afraid of floating relative to, the dollar, also is afraid of floating. I think Jay Powell.
You know, Vincent, doesn't the Fed have a large responsibility here, though? Even though the dollar falls under the Treasury, this dynamic they have of easing at a time where some are questioning whether there's a valid reason to ease, can't that be viewed by other major central banks as a de facto currency issue?
For sure. I think Jay Powell looked at the financial landscape and saw that U.S. interest rates was the nail that was sticking highest out, and he's hammering it down because that was attracting capital flows to us, and that was tending to appreciate our currency. And I assume the Fed's explanation right now is what John Connolly said in the 70s, our dollar, your problem.